Welcome to Honest Money, your best guide to financial freedom. I'm Warren Ingram, the author of a few best-selling books, and I'm also an award-winning financial planner, and I've helped thousands of people on their journey to financial freedom. I'm not here to tell you what to do, but I am here to share my experience and the best ideas that I've learned, and I hope these ideas help you on your journey to financial freedom. Welcome to Honest Money. I think it's a really exciting episode for some of us, and maybe a demystifying, potentially a scary experience for the rest of our listeners. I'm really excited to introduce you to Andre Bothma, who is a tax guru. He's certainly available on Twitter under Andre Bothma Tax. And I guess, Andre, one of your passions and one of the reasons why we reached out to you was because you're someone who actually wants to teach people about tax in South Africa, and more to the point, you're one of the outliers that actually finds this stuff interesting and exciting.
Yeah, no, that's 100% true. I don't know how it started, but I was a bookkeeper for 3 years, and then the tax manager at the firm pulled me aside and she said, you can do this tax stuff. Maybe you should give it a shot. And so that's where my journey started. And I'm very passionate about teaching tax to the average Joe, the average Jill, the average South African.
So at the moment, you give tax advice. You do that as a job. You're running on Twitter as well. And then you were telling me as well that off air that you're a content creator for Banker X as well.
Yes, that's correct.
Okay.
Yeah,
great. So, like why have one role when you can have multiple? I guess that's the modern age.
Yeah, I feel like the creative space is something that I like doing because tax can be very monotonous. It's always the same numbers. It's always the same clients each year in the job. So it's nice to connect with people on social media and to have a creative outlet through Banker X. So. Yeah.
Okay, great. So let's get into it. We're talking about tax, and I think maybe I wanted to start with how we can keep ourselves out of jail and out of paying penalties to SAR. So what are some of the really big sort of tax mistakes that people make?
I think one of the biggest things is a lot of people, or some people, have this head in the sand scenario where they want to avoid SARS and they want to. If I just stay away from SARS, I'm gonna be fine. But then what I've seen is people don't submit their tax returns for 3-4 years, and then when they're supposed to catch up their tax returns, become compliant, they realize that the problem is growing. Then they sit with a potential tax bill of 80,000 rand, 100,000 rand, where each year, if you just submit your tax return each year, the tax bill might be 10 grand. But if you leave it for 5 years, obviously it accrues penalties and potential penalties and an interest for all the unpaid taxes. So that's one big thing, is not submitting your tax returns head in the sand scenario. Another thing, which I think is, it's more a systematic problem, but it's more not realizing what tax benefits you have as an individual. What can and can't you deduct for tax purposes, like a retirement annuity being one of the best tax saving vehicles, tax deductible donations, medical aid tax credits. If you use the vehicle for travel allowance, you must keep a logbook. If you don't keep a logbook, you can't get your a tax deduction for it. And then also I think the third mistake I think people make is they glorify the tax saving inside a company. Now, I understand there's obviously benefits of having a CIPC registered company, but there's this misnomer where a company has a 28% flat tax. But if you're a sole director, sole shareholder, and the only employee of that company, in order to take the money out, you either need to pay yourself a salary or you need to pay yourself dividends. And if you pay yourself dividends, the tax end up being 42.4%, which almost doesn't beat the 45% tax bracket, and that's specifically because you're the company. So I think that's a misnomer and bad advice is where you start your own company thinking that you're going to save on taxes. So those are definitely three things that I would can comment on.
Yeah. Okay, and I must say, often talking to people around tax, I think one of the other big mistakes they make is that they do things. They either do investments or they come up with structures specifically to avoid paying tax. And if you really don't want to pay tax when it comes to investments, and I'm not talking about a retirement fund. I think that is a very good way to save tax, and a very healthy way if you're paying the right costs. But if you don't want to pay tax, just go and make a really lousy investment and lose all your money. That's a fantastic way not to pay tax, right?
A good example is the Section 12J investment.
Yeah, exactly.
I mean, people love that structure, but the problem is it was marketed at being this 100% tax deduction. But what a lot of these VCC companies did not do is they didn't tell you about the 5-year clawback. So you are tied into this investment for 5 years. And if the investment underperforms and you sell the investment, you have to recoup the amount that you've written off and include that in your taxable income. So that's a good example of people wanting to get that big tax deduction, but then they could be shafted if it's a bad investment.
Yeah, and I think most of the time, if someone arrives on my doorstep to sell me an investment, and I say to them, okay, can you tell me about the investment? And their first key selling point is, I'm going to save you a lot of tax. If that's the first thing they're going to tell me about a quality investment, it tells me it's probably not a quality investment, because what you should be telling me is it's going to generate X profits for the next 5 years, and it's going to do this, and it's going to grow in market share and all of these kinds of things. But if your opening gambit is, gee, I can save you tax in year one, then that means you're probably, a high quality investment should stand on its own. If it happens to have some good tax benefits as well, that's wonderful.
Yes.
And I must say that for me is always the big mistake. Especially when you talk to people that have accumulated a fair amount of capital, these kind of tax advisors arrive and say, I'm going to save you a lot of tax, because everyone hates paying tax. I understand that. But don't do silly things and lose money to save tax. That doesn't make sense. I view capital gains tax or income tax as a performance fee. It means that I've grown things and I'm paying some tax on the growth. That's okay. I don't mind doing that.
Yeah. No, that makes sense. And tax for me, I'm busy writing a book on tax, and a section of one of the principles that I talk about is that tax is always a second or third order consequence. You must never look at SARS or tax as the first order consequence of the investments that you make or the financial life decisions that you make, because it's a side consequence. The main benefit is the first thing. You don't go to you go to the gym. The first order consequence is you're going to feel sore. But the second and third consequence is that you're going to feel healthy. And so you have to consider the second and third consequence. But with investments, you have to, like you said, think about what is the first order benefit, the first order consequence, and then what is the second and third order consequences, such as tax and fees, for example.
And so I think my other big comment for people around tax mistakes to avoid is try not to be too complicated. A lot of the time nowadays you'll talk to someone and they'll say, I want to avoid paying estate duty, so I'm going to come up with some clever structure that involves an offshore trust and an offshore pension scheme and all of these things, and get heavyweight tax opinions. And the thing to understand is, if you're creating structures specifically and only to avoid tax, you might get away with it in year one or year two. But it's amazing how not stupid SARS actually is. And eventually they wake up to this stuff and they change the rules, or they just enforce the rules a bit more stringently than they might have done. And all of a sudden, these very complicated structures that you've put in place start to fall away. and potentially come back at you with a vengeance. So your first comment around don't avoid SARS, I think, is a good one. Engage with SARS, do your pay your returns, stick to the rules and those kinds of things. But secondly, don't specifically do structures only to avoid tax. I think SARS gives us a few very legal, very well-structured ways to avoid paying tax, and those are good. We should take advantage of them. But the moment you've got some very clever accountant with respect to the accountants, or a clever lawyer arriving to say, "Hey, I've got a complicated structure for you that's going to save you tax," watch the space, because the point is you're going to pay the tax. You just don't know when it's going to arrive, and it might arrive with some nasty penalties as well.
Yeah, and SARS's first line of defense, or one in the general avoidance provisions, their first line of defense is, does this make business sense? Meaning, if you did not get the tax benefit, would you still create the structure? And that's why local trusts are still used today to mitigate estate duty. It's local. Many people do it for asset protection reasons. That's why it's still, and it's much cheaper than foreign trusts or a complicated structure. And often the accounting fees or the fees, the lawyer fees and setting up the structure can often cost an arm and a leg to get it set up. But again, the argument is those with the money can pay for it. But yeah, keeping it simple has been my way of dealing with people's taxes in general for the last 10 years now.
So then let's get to some of the things that people should be doing. What are some of the things that we can do to be clever with tax? The things that we should know about.
Yeah, I think the first thing to try is at least get yourself educated if you can. There's obviously there's my YouTube channel. Mine is not the only YouTube channel, but SARS's website, there's a lot of answers or questions on SARS's website that you can immediately go to and educate yourself. Get onto Twitter, because there's a lot of talk on taxes on Twitter as well. So the first thing is educate yourself, know and understand where does your tax go to, why are you paying it? Because I think if people know why they're paying for something, or imagine not paying tax and what would happen to our country if government would receive no tax revenue for the next 2 or 3 years. What would happen as a country? There's no pensions for the elderly. Public schools will dry up, so there's no education for secondary or primary education. Universities will have. So think about those things that your tax money is actually paying for. But in terms of things that people can do to save on taxes, like I said, get yourself a retirement annuity if you don't have one, a low-cost retirement annuity as to save on some taxes, and get financial advice to get the right one for you. For individuals, that's a very easy and basic one to get. Again, if you get a travel allowance, keep a logbook. Also, a big one, turnover tax is a thing that people have forgotten about, or seem to have forgotten about. If you're a qualifying company or individual that's got a business and it falls within the framework of turnover tax, you can say up to R1 million of turnover, your tax is only going to be about 16,000 Rand a year, compared to if you had it in your personal capacity or you had it in a company structure, the tax might have been around 250,000 for up to R1 million. So turnover tax is a great tax regime. Also, small business corporation, that's another corporate tax benefit that people can register as. I think another one that people like is rental properties. The only downside about rental properties is that in the first 3 to 5 years, rental properties don't really make a profit, but it's a great vehicle to grow your net worth over time, and you can mitigate the tax effect for and until you want to pay off your rental properties. Those are a few things.
Okay, so let's hit the property one first. I want to go backwards in order a little bit. So the property one. I mean, we've certainly had people on the show in the past that have made very good money out of doing rental properties, buy to let properties, and I certainly I'm not dismissing it as a type or style of investment, and potentially with the tax benefits that you're talking about. But I think our first comment does apply as well here, right? So be careful when you make a big investment like that you're not doing it to save tax and actually end up making a lousy investment with property. Make sure you've chosen the right property, do your homework, make sure you understand tenants, understand cash flow. The worst thing is that you owe the bank a lot of money and then you don't have a tenant, or your tenant hijacks the property and you haven't got cash flow to cover the emergencies that come in and maintenance and all of those things. So I like it. I think it's a good strategy for people that do their homework, that understand the thing. It's not a no-brainer. And it's certainly not a risk-free way of investing. I think there are lots of people now that own some rental properties, in post-COVID world, that are burning and would love to have a tax problem of paying too much tax at the moment, but they don't, because they don't have tenants and they've got bonds. So a big one, that I think, just to be careful when you make those decisions.
Yeah, my comment about rental properties is, remember that it's not a passive income. It's a very much an active business that you are taking on in addition to whatever you're doing in your life. Because even if you have an agent that's managing the property for you, that is still yours. You must still cover the repairs and maintenance. You must have a sizable emergency fund to cover for capital losses, or and what happens, like you said, if you have a bad tenant or things like that. So definitely things to look out for. It's not I know South Africans love their rental properties, but it's not the be all and end all.
No, and then I think we're 100% in agreement, you and I, on an RA or a retirement fund in general is a very good investment, provided you choose one that is very low cost and that's efficiently managed. I hate ones that lock me into a contract. So if I'm going to my own retirement fund is a pay as you go. I can move it at any time to another retirement fund provider if I needed to. And I make sure that those costs are limited. The one that I think I wanted to add, I feel like I've got nothing to add to the show. You're covering it so well, but is definitely tax-free savings accounts for me is a no-brainer. I think again, low cost. Again, make sure you've got the right underlying investment. Don't go and put it all in a current account or a fixed deposit and think that your tax-free is the right place to be. It should be in something that's high growth and designed for long term, but definitely. Definitely a no-brainer. If you've got money and to save every month, splitting it evenly between a tax-free and an RA, to me, makes a lot of sense.
No, I love tax-free account. I think that the one thing that it's not fully tax-free, not 100%, because it does form part of your estate duty. So it does form part of your assets for estate duty. And then also, if you get foreign dividends within the tax-free savings account, then there will be foreign dividend implications there.
Thank you. I think that's it's a fine detail point that a lot of us would miss. I certainly forgot about the foreign dividend part. So good point. That I guess one of the ways to be careful with an overseas based investment in your tax free is choosing the style of unit trust where they don't pay out dividends. They just accumulate everything as capital. I think the category of funds in those instances are called accumulation funds overseas. And then if the local unit trust owns an accumulation fund inside your tax-free, you should be limiting your foreign dividends there. One I always wonder about, and maybe you can help us, is if you've got children, is it possible for your parents, in other words, the children's grandparents, to pay for your kids' education?
Yeah, so there is a special section. So if you were asking if can grandparents pay for the education of the kids? So there's a special exclusion under donations tax, which is basically called the maintenance exclusion, which means that I don't pay donations tax if I'm maintaining my wife. If my wife is a stay-at-home mom and I maintain her. I don't have to pay donations tax. It's a similar thing with my kids. And if the grandparents can cash flow for the children's education, that I would I would see that, in my tax opinion, I would see that as a tax exempt donation from the grandparents to the kids. I wouldn't see that as having donations tax implications.
So that's a great tip for a lot of parents who maybe are struggling with financially at the moment, and looking for ways to get a bit of help from the grandparents. That might be a nice way. But I mean, I think we'll probably both say that, you and me, Andre. But be careful. The grandparents should pay those fees directly. In other words, not pay it to the parents. Give them the cash and then say to the parents, "Hey, you go and pay the school fees."
Yeah, I think the wording is important. It must be a bona fide maintenance. So it must actually be for that thing that you're paying it for. It can't be, because if it flows through to the parents might do something else with the money and then use only a part of it to pay for the education. So then you have a bit of a problem there.
All right, I'm conscious of our time here, Andre. So we this thing has flown by. I thought this would be an interesting one, talking about tax, and I wasn't wrong. If there is one thing you would want someone to know by the end of this show, what is that one piece of advice that you'd love to give?
I think the biggest one is, don't be afraid of SARS. The thing is, SARS, all SARS expects of you is taxpayer honesty. So, and what you declare to SARS, as long as what you declare to SARS is for you, that's correct, and SARS comes back and they don't have issues with you, then you're fine. Because I think there's a lot of things in mainstream media where where they make SARS feel like this big monster that's after everybody, and you're going to go to jail, you're going to get fined, but it's all scary talk. It's SARS isn't this. They're not the jailer. That's not their job. Yes, people do get jailed. Yes, people do get fined. But that's if you've stepped so far out of the line. Just be compliant, and don't be afraid of SARS. Don't be afraid of dealing with them.
Yeah, and if you're a dodgy person practicing corruption for the last decade or two, you should be very scared of SARS, and I hope you go to jail. On that note, I just want to give you a shout out, Andre. I think follow Andre on Twitter. It's Andre Bothma Tax. Your YouTube channel, you didn't give us a punt there. What's that called?
Andre Bothma Tax. So you can just search
there you go.
Andre Bothma Tax.
Okay, fantastic. Andre, thank you so much. That was really really interesting. Talking about tax can be scary and often boring, but you made it exciting for me, and that's unusual. I appreciate you on our show, and thanks so much.
Thank you, Warren. Thank you for having me. It was a pleasure.
Thank you for listening to Honest Money. If you have any questions, you're welcome to reach out to me on Twitter. My handle is @Warren Ingram. Don't forget to subscribe. We're on Spotify and Apple Podcast. Chat soon.